Hey everyone, Sterling here from Day Trading Forex Live. This is going to be part two of a video series we started last week, Forex Trend Trading. Part one is the trend to your friend. It was the first video, and you can go and you can see that under the video section on the site. But in that video, we talk about how they tend to trend the price in waves of three. And in this video, we're going to talk a bit more about timing. One of the, it's important to know that they tend to trend the price in three waves, but it's also important to understand that not only is it driven in three waves, but where's the entry, or where's the higher probability of getting the point where you should be entering. And what we're going to focus on a bit more today is the tendency for them to manipulate the price before starting the next wave. So in the context of the start of a move, which we're going to start with here, once you've entered an accumulation phase where it's just essentially range bound market where they're hitting the highs, coming back, hitting the lows, hitting the highs, hitting the lows, before they make that first push, they're going to tend to hit the stops opposite the direction they're going to drive the market. Again, we'll talk about the reason behind that, but in a stop run, what happens? Uh, in a stop run, when you have a stop run above the highs, in other words, when the price pushes above the highs and is rejected back down below it, what happens? Well, on the retail side, what are retail traders doing at that point? As the price starts to roll over, the indicator's not starting to roll over here. You have those that are buying on the breakout, and additionally, those that are buying because they're getting stopped out of their short position. If anybody that was short expecting this high to hold, more than likely had their stop just above that high. As the market pushed above that high, they were having to buy that position back. So there's a lot of buy orders above that price. And again, if smart money wants to sell, what do they have to do? Well, they have to find somebody to sell to. Therefore, they have to induce buying to sell into the buying pressure before driving the price down. It's no coincidence that there's a stop run or a manipulation move almost every time before the market will move. So before the market moved down, they induced buying, sold into the buying pressure, and started to work off to the downside there. Now, same thing again here. Nothing, not a huge stop run, but we had this accumulation towards the end of the Asian market. And then what do? Again, if the first push was down, referencing the last video, then we're expecting two more cycles to the downside. That means that you're going to see the only direction you're looking for a stop run is you're looking for a stop run to the upside, or that manipulation move to the upside before the second move is about to start. So again, what do we see here? See them just slightly take out the tight stagnant accumulation that we had here, a couple hours worth of accumulation. They took out those highs just slightly before driving the price down. Nothing huge there, but again, illustrating the purpose of the false push above a high before ultimately driving the price down. Same thing here, the high of Asia. What do they do before making this move down? Well, again, they take out the highs with a stop run before driving the price to the downside. Now we're going to go back and look at some more examples of this here. Let me get rid of this, and we'll go back and we'll look at some examples here on the move up. What did we have? Again, we had that first push up. So let's assume you didn't catch the first push. If you saw the first push, you're saying to yourself, okay, well, we should see two more cycles to the upside. It tends to be the way smart money drives the price. So in the room, and actually in the forum, we were saying around this time, we were saying, okay, let the market pull off the highs, enter the Asian accumulation, then we're going to look for the stop run or manipulation move down before the second move to the upside. Again, because the first wave was up, we're only looking for the stop run down. In that case, they're taking out the stops low. They're triggering any selling they can, buying into that selling pressure before driving the price up. So what happens? Pull the price down, enter that Asian accumulation, and what do we see? Well, we see a stop run on the Asian lows. See the market work through that low, get rejected back to the upside. The stop run or that manipulation move in the bottoming formation is what marks the second push to the upside. Now again, if this was the second push up, we're expecting one more up, so what do we expect? Well, we expect them to, again, hit the stops to the downside, trigger any selling they can. Again, what type of sellers below that point? Well, you have the London breakout trader, very common strategy. You also have those that were long, expecting this level to hold, that are getting stopped out as it breaks below that point. Again, came down, gave a little bit longer bottoming formation. Formations, candle, and chart we'll get into in the next video. Just want to illustrate the point of the manipulation you tend to see. And again, it's important to start out. The reason we started out with the first video is because we identify the overall perspective. They tend to drive the price in three waves over the course of 3 or 4 days. Each move tends to be 90 or so, at least 90 pips. And so what that does is once we've identified the first push, we're expecting two more to the upside. So we're looking for only manipulation moves down to signal the start of the second push up. Again, after the second push, we're looking for only manipulation moves down to signal the third push. And so it all ties in together. We start out with, okay, what overall cycle are we in? Okay, if we're in the second overall cycle to the upside, then we're only looking for stop runs or manipulation moves down before the start of the third push to the upside. And this is where the timing comes from, guys. This is where understanding the levels is key, but the timing of the entry is also key. Now, generally, one of the better times for seeing this manipulation is out of the Asian session. So starting with 2 o'clock, 3 o'clock in the morning Eastern, which tends to be which is the start of the European session, 3 o'clock being the start of the London session. And the reason, you think about it, and I'm sure a lot of you have heard this, you've heard of the Frankie fakeout. Well, what's the purpose behind the Frankie fakeout? There's a name because it happens with such consistency, but why does it happen with such consistency? It happens with that level of consistency because they have to have, in this case, if they're driving the market up, they have to have sellers. They buy into the selling pressure, accumulate that long position, and then drive the price up once they have the desired position they were looking to accumulate. That is a must, and that is one of the safer times for taking a trade. Now that in no way, shape, or form really means that you're not going to see opportunities during the New York session. The New York session is the session that I trade. It tends to be where I get most of my trades from, and it again revolves around the fact that manipulation is key. But the thing with the New York session is oftentimes you're coming in at the end of a move, and so it allows you to capitalize on once you're seeing the third cycle completing the stop run that's often found at the end of the third cycle. Again, why do you see the stop run or that topping formation at the end of a third cycle? Because they're exiting a position. If they were long, and we'll go to a good example of this here. Give me just 1 second. We'll go out to an example of there's actually a stop run at the end of the third move there. There's a larger stop run at the end of the third move here, which will illustrate, but it happened during the New York session. And we'll zoom into a 15-minute. Again, this is the third push down, and when we go out to actually come over to the next day, this gave two opportunities. This is where I was mentioning it in the forum over here, but also gave another nice opportunity over here. But what would be the purpose of them driving the price down into the New York session, taking out the stops? What's the purpose of them taking out the stops? Well, this level, if you see here, it's 3,100, so it's a psychological barrier. It's again a point where most retail traders are putting their orders in and around those psychological barriers. It's also a previous support point, and so when you take that into consideration, what's the standard retail trader going to do? Well, anybody that was long would have their stops below 3,100 by a few pips. And also you have those that are looking to sell the breakout. So anybody long is getting stopped out. They have to sell it back. That's one type of sell order. And also those that are selling on the breakout, obviously that's another type of sell order. And so smart money, they've been driving the price down. Again, they drove the price down here in 3 cycles to the downside. And so they're net short on the euro. If they want to exit that net short position, what do they have to do? Well, they have to induce, sorry about that, let me go back here. Again, if they've been net short through this move to the downside, so what do they have to do if they want to exit that short position? Well, if they want to exit that short position, they have to induce more selling. If you're short and you want to cover your position, you have to buy it back. If you want to buy it back, you have to have somebody to sell to. So by triggering all those sell orders with the stop run, they're able to close out more of that short position. They've induced more selling. They've bought back their position, thus exiting their position and going flat at that point. And that's why you often see the stop run at the end of a move. It's no coincidence that at the end of this move there was a stop run. The end of this move there was a stop run. Again, it took out the lows at the end of that third push. It will go back even some more here. We'll go into the 15-minute chart, and you can see a stop run at the end of this move. Into the third push, you see them create a stop run there. So that stop run is the key to the stop run or the manipulation, the bottoming or topping formation, which we'll get into. Again, that goes into even the stop run goes into candle formations and chart patterns, and I use those words reluctantly because we don't want to get caught up looking at candle patterns or chart patterns without the context of what cycle you're in, which we talked about in the first video, or when you're looking for that manipulation or which direction you should be looking for the manipulation. The candle patterns and chart patterns mean nothing. So we'll get into that a bit more in the next video, and that's what the next video will be about. But the key point to take away from here, guys, is once you've identified the first push, you should be expecting two more. So if you've identified the first push up, you're expecting two more to the upside. What that means is when you see that accumulation, you're looking for only the stop runs to the downside or the bottoming formations to the downside, which is giving you the indication that, again, they manipulate. If they're driving the price up, they're going to manipulate it down and do selling, buy into the selling pressure before driving the price up. Look through the market, guys. Look at the fact that you see this manipulation out of the Asian session, especially during the European and the London Open with a high degree of certainty, especially once you've entered that smart money cycle. That pattern of manipulation is very clear, and that's what gives us a much clearer picture as to timing and timing the entry. The final part to that timing is the candle formation confirming it, or that bottoming or topping formation confirming it, which we'll discuss a bit more in the second video. But look for that manipulation. There's a reason why I get so many emails of traders saying, I get the direction right, but I get stopped out by a few pips before the market moves in my favor. That's not when it happens with such consistency with so many traders, it becomes a question where you have to ask yourself, do you think this happens by chance? And when we go back to the very basics of how smart money has to trade, they have no choice but to induce the other side of the market. In this case, if they want to go long, if they want to accumulate that long position, they induce the market short, buy into the selling pressure, and that manipulation move starts a second push up. They induce the short, start to work below the lows, trigger the stops, trigger anybody selling on the breakout, and they buy into that selling pressure. That's what marks the third push up. So that manipulation move is going to be, when used in context, a very, very powerful tool, and is the second step really in identifying a trade, and it's getting more into the timing of it. In the next video, what we're going to talk about is the actual, again, chart patterns and candle patterns, for lack of a better word. That is really the icing on the cake. It's the last final step. In and of itself, they mean nothing in the context of what smart money is doing. That's where they can become really powerful, and that's what we'll be talking about in the next video. As always, Chad and I are always happy to answer emails. You can use the contact form on the site or email us at daytradingforexlive@gmail.com. We'd be happy to get back with you on that. All right, guys, until next time, happy trading.